Good afternoon, everyone. My name is Luke Johnson, and this is my teammate, Nicolas Benedeti. Today, we'll be presenting a cell on the Enterprise Product Partners. So a brief company overview. They operate in the energy sector of the oil and gas industry. They are one of America's largest midstream MLPs, and they operate on an integrated system of NGL, crude oil, natural gases, petrochemical pipelines. They also have storage assets and export terminals. And a brief overview of the recent growth that they've had over the past 5 years. We've seen a 20% CAGR, but they've slowed in the past 3 years. In the past 1 year, you can see a 7% growth, which is significantly slower. And then this is also reflected in the stock as well. And then they currently sit at a $32.43 price point. So looking at the past portfolio performance, we bought at an initial shares of 1,300 at a cost basis of 16.88. And then our current market value of our shares are 40,800. And then we've been collecting investment income on the dividend yield of on average 6.25% to 6.8 over the past 5 years or so. Assuming we bought in 2020, 2021, where we've earned 14,000 in this dividend income. And then putting these two gains together, we get a unrealized gain of about 80% or 1,800. And then adding this to the investment income is 32,900. So this brings us to our divestment thesis, in which EPD has a large exposure to the NGL industry, which there's currently oversupply and there's a lack of demand absorption within the industry and this specific line. And the NGL industry is just tightening margins for companies like EPD, which already have among the lowest within their competition. And then we're also seeing slowing volume growth across the U.S. midstream as well. There's just slow production from upstream companies, just overall general decreased midstream volume. And then you will also see this take a hit with declines in oil prices projected to happen within the next 1 to 2 years. There's also fundamental operational lags within the EPD business. They have accelerating leverage and stalling cash flows, which we'll see a graph later on, and then weak valuation compared to the peers that they are currently operating against through lower dividends and lower operating margins. So just briefly looking at the revenue, the NGL pipeline services, obviously one of their bigger categories now that they're overreaching in, and we project them to grow at about 8.2% moving forward, which might be a little generous. But another one of their big ones are crude oil and pipeline services. We project this at 7%, as well as the petrochemicals. And then this data, these growth rates come together collectively at a 7.3 CAGR over the next 5 years projected.
So working towards our discounted cash flow model, we, even with pretty aggressive revenue projections, we still project this to be a loss. And notably, we can look at their debt. Their debt is increasing year after year, and they're struggling to raise cash flows. Despite paying a high dividend yield, they're struggling to present the free cash flows. So it gives us the presumption that their price is it's inflated based on their dividend yield. So if they're not able to sustain that, we expect this to come down quite a bit. Touching back on the actual discounted cash flow model, we do have a pretty relatively low cost of capital at around 6.74%, which gives us a terminal value of about $110 billion. which breaks down to a share price of $32, which is basically in line where it is today. So working towards the valuation, we actually do project a very, very small upside within the next few years. And this is because their multiples, we're projecting their multiples to stay relatively similar or go towards their competitors. And even so, it's still not very hefty upside. It's around 6.58% upside we're projecting is their corrected value. It's our valuation. And if you bake in the dividends, that's not really beating the market. And if they do end up decreasing their dividend payouts because of lack of cash and free cash flows and their liquidity issues, I do expect this company would be able to squeeze down quite a bit, and we would see that reflect in their stock price. So looking back at their comps, they do have, they're not very far off. This entire sector seems to be a little bit inflated based on these high dividend yields. They are paying quite a hefty amount of money, and this ties back into the sustainability of those dividend payments. They have been very sustainable historically, but as we can see, they're struggling to produce these free cash flows. And with that considered, that could dig into the dividend payments, which could dig into their share price. As we can see, their price to earnings, their EV and EBITDA, all those comps are very much in line with their competitors. So we do expect this to be more of a kind of a top heavy market where EPD is kind of struggling the most to produce these cash flows because they're not able to have the growth that they've historically been able to do because of the shortage of new demand for these not or NGL pipelines. Thank you. If you guys have any questions about the model or how we came to calculations, please feel free to email us. My email is benedetti@usf.edu and Luke Johnson is johnson353@usf.edu. Thank you so much for watching our video today.
Thank you.
Thank you.